Ladies and gentlemen, the Vice President and I are very pleased to welcome you to our press conference. We will now report on the outcome of today's meeting of the Governing Council. Based on our regular economic and monetary analysis, we have conducted a thorough assessment of the economic and inflation outlook, also taking into account the latest staff macroeconomic projections for the euro area. As a result, the Governing Council took the following decisions in pursuit of its price stability mandate. First, as regards the key ECB interest rates, we decided to lower the interest rate on the deposit facility by 10 basis points to minus 0.50%. The interest rate on the main refinancing operations and the rate on the marginal lending facility will remain unchanged at the current levels of 0 and 0.25% respectively. We now expect the key ECB interest rates to remain at the present or lower levels until we have seen the inflation outlook robustly converge to a level sufficiently close to, but below 2%, within our projection horizon, and such convergence has been consistently reflected in underlying inflation dynamics. Second, the Governing Council decided to restart net purchases under its asset purchase program at a monthly pace of 20 billion euro as from November 1st. We expect them to run for as long as necessary to reinforce the accommodative impact of our policy rates and to end shortly before we start raising the key ECB interest rates. Third, we intend to continue reinvesting in full the principal payments from maturing securities purchased under the asset purchase program for an extended period of time past the date when we start raising the key ECB interest rates, and in any case for as long as necessary to maintain favorable liquidity conditions and an ample degree of monetary accommodation. Fourth, we decided to change the modalities of the new series of quarterly targeted longer-term refinancing operations, TLTRO III, to preserve favorable bank lending conditions, ensure the smooth transmission of monetary policy, and further support the accommodative stance of monetary policy. The interest rate in each operation will now be set at the level of the average rate applied in the Eurosystem's main refinancing operations over the life of the respective TLTRO. For banks whose eligible net lending exceeds a benchmark, the rate applied in TLTRO III operations will be lower and can be as low as the average interest rate on the deposit facility prevailing over the life of the operation. The maturity of the operations will be extended from 2 to 3 years. Fifth, in order to support the bank-based transmission of monetary policy, the Governing Council decided to introduce a two-tier system for reserve remuneration, in which part of banks' holdings of excess liquidity will be exempt from the negative deposit facility rate. Separate press releases with further details of the measures taken by the Governing Council will be published this afternoon at 3:30 p.m. The Governing Council reiterated the need for a highly accommodative stance of monetary policy for a prolonged period of time and continues to stand ready to adjust all of its instruments as appropriate to ensure that inflation moves towards its aim in a sustained manner, in line with its commitment to symmetry. Today's decisions were taken in response to the continued shortfall of inflation with respect to our aim. In fact, incoming information since the last Governing Council meeting indicates a more protracted weakness of the euro area economy, the persistence of prominent downside risks, and muted inflationary pressures. This is reflected in the new staff projections, which show a further downgrade of the inflation outlook. At the same time, robust employment growth and increasing wages continue to underpin the resilience of the euro area economy. With today's comprehensive package of monetary policy decisions, we are providing substantial monetary stimulus to ensure that financial conditions remain very favorable and support the euro area expansion, the ongoing build-up of domestic price pressures, and thus the sustained convergence of inflation to our medium-term inflation aim. Let me now explain our assessment in greater detail, starting with the economic analysis. Euro area real GDP increased by 0.2% quarter-on-quarter in the second quarter of 2019, following a rise of 0.4% in the previous quarter. Incoming economic data and survey information continue to point to moderate but positive growth in the third quarter of this year. This slowdown in growth mainly reflects the prevailing weakness of international trade in an environment of prolonged global uncertainties, which are particularly affecting the euro area manufacturing sector. At the same time, the services and construction sectors show ongoing resilience, and the euro area expansion is also supported by favorable financing conditions, further employment gains, and rising wages, the mildly expansionary euro area fiscal stance, and the ongoing, albeit somewhat slower, growth in global activity. This assessment is broadly reflected in the September 2019 ECB staff macroeconomic projections for the euro area. These projections foresee annual real GDP increasing by 1.1 in 2019, 1.2 in 2020, 1.4 in 2021. Compared with the June 2019 staff macroeconomic projections, the outlook for real GDP growth has been revised down for 2019 and 2020. The risks surrounding the euro area growth outlook remain tilted to the downside. These risks mainly pertain to the prolonged presence of uncertainties related to geopolitical factors, the rising threat of protectionism, and vulnerabilities in emerging markets. According to Eurostat's flash estimate, euro area annual HICP inflation was 1% in August 2019, unchanged from July. Lower energy inflation was offset by higher food inflation, while the rate of HICP inflation, excluding food and energy, was unchanged. On the basis of current futures prices for oil, headline inflation is likely to decline before rising again towards the end of the year. Measures of underlying inflation remained generally muted, and indicators of inflation expectations stand at low levels. While labor cost pressures strengthened and broadened amid high levels of capacity utilization and tightening labor markets, their pass-through to inflation is taking longer than previously anticipated. Over the medium term, underlying inflation is expected to increase, supported by our monetary policy measures, the ongoing economic expansion, and robust wage growth. This assessment is also broadly reflected in the September 2019 ECB staff macroeconomic projections for the euro area, which foresee annual HICP inflation at 1.2 this year, 1 in 2020, and 1.5 in 2021. Compared with the June 2019 staff macroeconomic projections, the outlook for HICP inflation is being revised down over the whole projection horizon, reflecting lower energy prices and the weaker growth environment. Turning to the monetary analysis, broad money, M3, growth increased to 5.2% in July after 4.5% in June. Sustained rates of broad money growth reflect ongoing bank credit creation for the private sector and low opportunity costs of holding M3. The narrow monetary aggregate M1 continues to be the main contributor to broad money growth on the components side. The annual growth rate of loans to non-financial corporations remained unchanged at 3.9% in July 2019. The annual growth rate of overall loans to non-financial corporations continues to be solid, although short-term loans, which are more sensitive to the cycle, show signs of weakness. The annual growth rate of loans to households stood at 3.4 in July after 3.3 in June, continuing its gradual improvement. Overall, loan growth is still benefiting from historically low bank lending rates. The monetary policy measures we've taken today, including the more accommodative terms of the new series of TLTROs, will help to safeguard favorable bank lending conditions and will continue to support access to financing, in particular for small and medium-sized enterprises. To sum up, a cross-check of the outcome of the economic analysis with the signals coming from the monetary analysis confirmed that an ample degree of monetary accommodation is still necessary for the continued sustained convergence of inflation to levels that are below but close to 2% over the medium term. In order to reap the full benefits from our monetary policy measures, other policy areas must contribute more decisively to raising the longer-term growth potential, supporting aggregate demand at the current juncture and reducing vulnerabilities. The implementation of structural policies in the euro area countries needs to be substantially stepped up to boost euro area productivity and growth potential, reduce structural unemployment, and increase resilience. The 2019 country-specific recommendations should serve as the relevant signpost. Regarding fiscal policies, the mildly expansionary euro area fiscal stance is currently providing some support to economic activity. In view of the weakening economic outlook and the continued prominence of downside risks, governments with fiscal space should act in an effective and timely manner. In countries where public debt is high, governments need to pursue prudent policies that will create the conditions for automatic stabilizers to operate freely. All countries should reinforce their efforts to achieve a more growth-friendly composition of public finances. Likewise, the transparent and consistent implementation of the European Union's fiscal and economic governance framework over time and across countries remains essential to bolster the resilience of the euro area economy. Improving the functioning of economic and monetary union remains a priority. The Governing Council welcomes the ongoing work and urges further specific and decisive steps to complete the banking union and the capital markets union. And now we are at your disposal for questions.
Mr. Skolimowski.
Piotr Skolimowski, Bloomberg. Good afternoon, Mr. President.
Good afternoon.
My first question would be about the dynamic in the room, because going into the meeting, we've seen quite a vocal opposition, especially to the restarting of the QE. So probably me and the others here would like to know how much support each of the instruments that were eventually adopted got, and whether how much support was there for it. My second question is specifically about your APP program, because it's effectively a program that's open-ended. It starts from November, which basically means you will end up buying bonds or assets for months or years. The question is, do you have the space to do it? Have you considered changing limits or adding other assets to the program? Thank you.
Thank you. If I can, before giving you the sort of the chemistry of the meeting, let me just spend a word trying to explain what we have actually done. I think, as I kind of sketched in the introductory statements, there were three elements that prompted action. Along lines, by the way, that you would find in my Sintra speech. First of all, and again, if anything, after Sintra, the case became even stronger, because the protracted slowdown in the Eurozone economy is actually more marked than expected, and that's the first element. The second element is the persistence of downside risks of trade nature, but also geopolitical nature in the Eurozone. And by the way, our baseline scenario that actually contains the third reason for acting, namely the downward revision in projected inflation, with the inflation expectations at this low level and the current underlying inflation being muted. This baseline scenario is also relatively favorable because it doesn't contain the case of a hard Brexit, for example, the probability of which has gone up over recent time. And it doesn't contain some of the trade measures, trade escalation at least, some of the trade escalation that's taken place since August. So in this, with this relatively favorable baseline scenario, there was a downgrade in inflation and inflation expectations. And so that's over the whole horizon. And that's what prompted the measures we've taken. And let me just spend a word explaining them, and then I will answer your points more specifically. First of all, the lowering of the DFR, the deposit facility rate, together with the reinforced forward guidance, operates all throughout the yield curve, especially in the short and the medium-term segments. And then you see that there is a different forward guidance today. It's a strengthened state dependent. There is no more calendar dependence. And this should give a pretty good guidepost, pretty clear guidepost for rate expectations by linking our policy to more stringent conditions for the inflation outlook. Over our projection horizon, projected inflation will not only need now to converge, but also, as I think I read in the introductory statement, also stabilize around a level sufficiently close to but below 2%. The reference to levels sufficiently close to but below 2% signals that we want to see projected inflation to significantly increase from the current realized and projected inflation figures, which are well below the levels that we consider to be in line with our aim. Our guidance would remain forward-looking, but at the same time, it contains elements that protect us against the risk of overreacting to transitory shocks of inflation, as well as against forecast and measurement errors, as we would emphasize that convergence should be robust. That's important. And also important is the reference to underlying inflation that will have to increase to ensure that the pickup in inflation is backed by a sustained build-up of domestic price pressures. I think that's the explanation of the first few elements of today's decision. Now, I can also give you an explanation of why the restarting of the APP is appropriate, but we can defer this to the next question, perhaps. And let me now move to the other point. Your first question was about the chemistry of the meeting. Let me start. First of all, let me start from one thing about there was unanimous consensus, namely that fiscal policy should become the main instrument. It's quite clear that in order to raise demand in an effective and timely, and that's, you've seen the language of the introductory statement after many years, I think, of being more or less the same about fiscal policy, now it's changed. And I think there was complete agreement about that. And if you see, also, if you compare what's happening in other jurisdictions where inflation rates are higher, and you look at monetary policies are broadly comparable in terms of easing capacity, you see that fiscal policy did play in these jurisdictions a much more active role than it played. And I'm talking now not only about this year, last year, I'm talking about the last 6-7 years. Almost all the things that you see in Europe, the creation of more than 11 million jobs over a short period of time, the recovery, the sustained growth for several quarters, were by and large produced by our monetary policy. There was very little else. Of course, there were structural reforms in some countries. So now it's high time, I think, for the fiscal policy to take charge. Second, there was a broad agreement on the parts concerning forward guidance and the rate cut and the reinvestment and the TLTRO. So you can see that that part was by and large agreed. And then there was, of course, more diversity of views, as it was vastly pre-announced by statements on all newspapers, wires, television, and so on. There was more diversity of views on APP. But then in the end, the consensus was so broad there was no need to take a vote. So the decision was, in the end, showed a very broad consensus. As I said, there was no need to take a vote. There was such a clear majority that. So let me now say one word about where the main differences actually lied in the discussion. I think there was, again, a full agreement about the need to act. But the difference of views were about the severity of the outlook. In other words, the majority of the Governing Council believed that the outlook was deteriorating as I said, in a way greater than expected, and the revision in the growth and inflation projections granted full action. Others viewed this deterioration with a little more caution. Second point was about the need to act now. As usual, you have always views that say, let's wait and see. and the Governing Council decided to act now this time. And the third is about the appropriateness of the APP. By the way, one reason also to act now concerns inflation expectations that we've seen, not only the ones that are now at low levels, but we see that inflation expectations are not de-anchoring, but are re-anchoring at levels between 0 and 1.5%, which is not our aim. That's why the Governing Council, in full consistency with its mandate, did decide to act now. And it's now, and the package is quite powerful, both in the short run, but also in the long run, in designing action over the coming months. So the appropriateness of these instruments, because some think that the APP is appropriate only for risks of deflation. Others thought that the level of interest rates is already so low that it doesn't need action on the APP. But the majority of the Governing Council believed that action was warranted. And so that was the chemistry, basically. Now, the limits. There was no appetite, frankly, to discuss the limits for one good reason. Because we have a relevant headroom to go on for quite a long time at this rhythm without the need to raise the discussion about limits. I think I will stop here.
Ms. Weisbach?
Annette Weisbach, CNBC. Let me take your point on the length of the program and also how long you think those measures are needed, because I think one of the surprising elements of the proposed package was that the APP comes in with an unlimited amount of time, right? So what are you expecting? How long does this need to prevail in order to really get inflation back to target? And in your experience, how much effort does the central bank need to do in order to re-anchor inflation back at where you want to have it? And then another question is, did you discuss also to move the marginal lending rate into negative territory? And is that an option which could be a next step? And why didn't you do it? Kind of enlarging the corridor now. Thank you.
Thank you. I mean, as far as the first question is concerned, we really think this package is adequate to re-anchor inflation expectations. And by the way, again, if I may repeat myself, if fiscal policy had been in place or would be put in place, the side effects of our monetary policy would be much less, the action of our decisions today would be much faster, and therefore the need to keep in place some of these measures would be less. So we believe this package to be adequate. Your other question was about whether we discussed. No, we didn't. We didn't discuss changing the marginal lending rates, no.
Mr. Sims?
Mr. Draghi, going into today's meeting, how many members early on in the meeting were actually against quantitative easing? And even though you didn't take a vote in the end. And did you also discuss higher amounts of monthly purchases before your final decision?
I'm sorry, the answer is that I can't tell you the numbers. We never did it, we're not going to do it. Just let you know that there was no need to take a vote, as I said, because there was such a significant majority. The second point is no, we didn't discuss it.
Mr. Arnold?
Can you address this issue of how long the asset purchase program will last? The markets seem to be assuming that this is QE ad infinitum. Can you also talk about the makeup of the QE, the type of assets that you're planning to purchase? And can you also talk about helicopter money? And what's your view on whether there could, in the future, be a need for direct action?
Okay. There was no discussion about the type of assets, meaning that by and large it's going to be the same we purchased in the past. Now, with helicopter money, I got to be very cautious, because last time I was asked this, was about a year and a half ago. I said, well, maybe an interesting thing, but we haven't discussed. And immediately everybody said, oh, they are talking about this and studying. No, we are not talking. It's not been discussed. It's not an option that we considered.
Ms. Mastrobuoni?
Yes, Mr. President, you will forgive me if I read your tweet. It's from Donald Trump.
Yes, I've seen it.
Yeah, some minutes ago. He tweeted like, European Central Bank acting quickly cuts rates 10 basis points. They are trying and succeeding in depreciating the euro against a very strong dollar, it's all capital letters, hurting US exports. And the Fed sits and sits and sits. They get paid to borrow money while we are paying interest. So I would like you maybe to comment this. And second, you know that in Germany there is a very strong discussion about banks and negative rates on deposits and their intention to transfer these negative rates on retail clients. I wanted to know if you have an opinion on this, and so that's my two questions. Thank you.
Thank you. Now, the first question, I, in a sense, answered to the first question on the occasion of the first tweeter. And the answer is very simple. We have a mandate. We pursue price stability, and we don't target exchange rates, period. On negative rates, I think today I have said several times, negative rates have been a very positive experience in terms of stimulating growth, sustaining inflation. But it's quite clear, and I did say this several times, that they have side effects. And they have negative side effects. And it's not so much that we want to protect bank profits. That's certainly not our mandate. But it's that we want to protect the smooth transmission of the lending channel. We should never forget that the European economy is a bank-based economy, that lending goes through banks. And we want to protect the transmission of our monetary policy through the lending channels. And I think that's the philosophy behind the tiering measures, the mitigating measures that we have discussed and approved today. Thank you.
Mr. Stumpf?
Hi, Mr. President. I would like to know the different options that the Eurosystem committees that were tasked to brought to the Governing Council. Thank you.
I'm sorry?
Which different options, I mean, besides the one adopted?
I think we don't discuss, by the way, when we have our discussions, we discuss the presentation of the chief economist, the proposal of the chief economist. And this proposal did not contain options. It was what I just read in the introductory statement, and I commented about. Thank you.
Ms. Ferraino?
Good afternoon, President Draghi. There is a growing consensus to change the rules of the Stability Pact, and the concern that pushed you to to restart a stimulus. Does this mean that you join this consensus? And second question, because the inflation expectation seems anchored to a different target of yours, would you support the view expressed also by your successor, Christine Lagarde, to review the inflation targets? Thanks.
Thank you. No, we made the case for fiscal policy to sustain demand, and we're making the case, and we'll make this case on and on, even more frequently in the coming future. We actually didn't discuss if you read, we didn't discuss the Stability Pact, and as a matter of fact, we have a sentence here that says exactly that the transparent and consistent implementation of the European Union's fiscal and economic governance framework over time and across countries remains essential to bolster the resilience of the euro area economy. Having said that, countries that have fiscal space, and we say this, should act in an effective and timely manner, if I'm not mistaken. Let me see. Governments with fiscal pace should act in an effective and timely manner. Exactly, in view of the weakening economic outlook and the continued prominence of downside risks. In countries where public debt is high, governments need to pursue prudent policies that will create the conditions for automatic stabilizers to operate freely. So the Stability and Growth Pact discussion is essentially a discussion between member states and the Commission. And these are the statements that we can make today. Now, the other question was about? Oh, no. The other question is whether we can. This, again, it was a question that has been asked many times, you can imagine, over these years. And by the way, you have two different camps here. The ones who say, listen, given that you are still kind of far from, say, 1.9, whatever is our aim, why don't you cheerfully and happily accept 1% as an objective so you can claim victory? Now, that is an issue that we always rejected. There is another camp that says, if you raise your objective to 4%, people will believe you and their expectations will go up. I don't want to prejudge. By the way, all this will be the topic of the strategic review that the next president will carry out together with the Governing Council. The reasons why we, during my tenure, we always objected to changing the target. By the way, the reasons are different whether you go up or you go down. But there is one common reason, that when you change a target that you can't reach, the action is not very credible. If you can't reach 2, why do you want to go to 4? And if you, and on the other hand, to change the other side would have other drawbacks. And so for a variety of reasons, so we've always refrained from changing this. But this, as I said, is going to be one of the topics of this strategic review.
Ms. Laird?
Thank you. I've got 2 questions, Mr. Draghi. The first is the asset purchase program was a little bit more hawkish than private economists expected. Your forward guidance was a little bit more dovish. Is that aimed at giving your successor maximum flexibility, including on rejigging or reconsidering any kind of purchase limits? The second question, if you'll forgive me, if we could go back to the tweeter-in-chief. Would any efforts by the U.S. to directly or indirectly weaken the dollar complicate your goals? And do you have any specific reaction planned should the U.S. intervene to weaken the dollar?
The answer to the first question is that we take our decisions really not with the idea of creating a kind of a ground for my successor, but we've taken our decisions, as I said at the beginning, on the basis of objective elements that have to do with a weakening of the economic outlook, a weakening that is more serious than expected, and with a revision in the inflation projections, and with the persistence of uncertainty. So these are the elements at the basis of our decisions today. Now, on the second question, we stick with the G20 consensus, namely that we will never pursue competitive devaluation. So we expect that all the G20 members would underwrite the same consensus.
Mr. Wiebe?
Yes, Mr. President. Thank you, Mr. President. I was quite surprised that a lot of economists who didn't talk that way and in the past are now changing their opinion and are questioning whether the side effects of the monetary policy, the negative side effects, will sometimes very soon be bigger than the benefits. So do you see any point in the future where this could happen?
I think that this concern is very well placed. I think we should be aware of the side effects of our policies, be there interest rates or asset purchases, and we are monitoring. We are closely monitoring the side effects. The Vice President, through its Financial Stability Action, is closely monitoring all these effects. So we are keenly aware. Now, to many of these side effects, the answer is not to change monetary policy, but rather implement specific macroprudential policies. But as I said, this is it's been a constant point of action, constant point of concern.
Ms. Boufaki?
Isabella Buffacchi from Sole 24 Ore. I have two questions. One is on one of the actions today on TLTROs, because there has been, I think, more than the market expected. They're longer, and there is not the 10 basis point on the top. And this is even before the TLTROs are in place. So is there a worry, preoccupation that loans are not really going to, especially SMEs? And then my second question is on this statement on effective and timely manner for government with fiscal space. Today, a very important think tank in Germany saw a recession on the horizon of Germany. And what is your view on the risk of recession? And do you think that a country should act before it has a recession rather than wait to have it to change the fiscal policy? Thank you.
Thank you. Well, when we approved, the first question is about TLTROs. When we approved the TLTROs, basically, if I remember correctly, there were two criteria. The first was to ensure that our monetary policy would be transmitted through the bank lending channel, and the second would be that those conditions would be dependent on the macroeconomic outlook, which has worsened since we approved the TLTROs, and therefore there has been an adjustment in the TLTROs conditions. The second point is about recession. We still think the probability of a recession for the euro area is small, but it's gone up. But still, we believe it's still a small probability. While with respect to Germany as such, well, we've seen today two business cycles institutes saying that it's either a recession already, or they foresee a clear recession, or it's about to get into a recession. I'm not, and so that's a case, but that's a case for timely and effective action on the fiscal policy side. By the way, let me say something I've said many times. It's in a sense easy to make recommendations to governments to do this and to do that. So in doing so, and you know this, I've said this many times, we've got to be extremely humble. It's something that we should say because the instruments ought to be activated. As I said, everybody was unanimous about that today. But we should also be aware that there are objective and specific difficulties about doing this in different countries, by the way.
Mr. Bonderman?
Thank you. This is a follow-up question to one of the questions of my colleagues about negative side effects. Your proposed successor, Christine Lagarde, also said in the European Parliament she wants to look more closer at the concerns of citizens about the negative side effects of the ECB's accommodative monetary policy. And one of such side effects is, of course, the severe pressure on pension funds through continuing low rates. It seems increasingly likely that large Dutch pension funds will have to cut payouts. So were the pension funds discussed at the meeting today? And is there, in your view, a risk that monetary policy actually harms demand, since people will have less money in their pockets? Thank you.
Thank you. The answer to the last point is no. We haven't seen that. But we certainly are very concerned about the pension and the related services industry, and certainly this is one of the side effects. Having said that, it's quite clear that to the extent that negative rates prompt or speed up the recovery, they will also benefit pension funds and insurance companies. So, and the main point here is really negative rates are necessary instrument of monetary policy, and this is what the Governing Council has stated now for quite a long time. It has created a lot of positive effects. How do we speed up these effects so that interest rates can go up again? And the answer is, once again, is fiscal policy at this point. By the way, as a matter of fact, I understand the Dutch government has a 50 billion investment program, and that's a good time to activate it. Thank you.
Mr. Huyton, please.
Luke Huyton, Market News. Mr. Draghi, can you say a little bit more about the motive for making the duration of the asset purchase program contingent on the first rate hike? And my second question was, you said that interest rates will remain at their present or lower levels until inflation not only converges, but stabilizes. Was the possibility or the desirability of inflation stabilizing temporarily above 2% discussed? Would you be against that, and if so, why?
Thank you. The answer to the second question was not discussed. So we really stuck with that definition, and with the aim as it has been expressed. And the symmetry means that we react to inflation rates that are below our aim with the same strength we would react to inflation rates which are above our aim. It seems obvious, but evidently it needed to be restated. So now, concerning the asset purchase program, let me just say a few things. First of all, it has a larger impact on longer-term rates and provides further support to the funding costs that matter for business and households. Also, with this formulation, the horizon of net purchases dynamically adjusts to changes in our interest rate forward guidance, and therefore works in the background to keep a lid on medium to longer term interest rates. So you see the two instruments interact together. By adding to the stock of assets and reinvesting for longer, we can postpone an undue tightening in term premia, which mechanically occurs as the APP's portfolio loses average duration. In addition, APP net purchases have strong signaling effects and wealth effects on the balance sheets of banks and other entities. And the APP tends to have a more powerful effect on the formation of inflation expectations by demonstrating our commitment to use all instruments in pursuit of our aim. You remember me saying this, that all instruments were on the table, that were all ready to be used. Well, today we did it.
Mr. Rasch.
Michael Rasch, Neue Zürcher Zeitung. Mr. President, again on the side effects, was there today in the Council a longer discussion about the proportionality of the program given the possible side effects? And which side effects are concerning you personally most? Thank you.
There was certainly a discussion about the proportionality, but it did not concern so much the negative rates. In other words, the consensus was, I would say, very, very, very broad on cutting the rates. So the proportionality discussion was mostly focused on the restarting of APP, where frankly the side effects are less visible. They may be there, but they are less visible than cutting the rates for the reasons that we have discussed before.
Mr. Jakic.
I'm sorry, you asked another question? Oh, well, I think I expressed that before. We should not, we should be very aware of these side effects. In fact, one of the answers we have is that with the tiering measures that we approved today, we're trying to protect the transmission of our monetary policy through the bank lending channel from some side effects that the negative rates might have. That's one example of answers. Of course, there are many other side effects we should be aware that go beyond banks, as it was asked to me a moment ago. Thank you.
Mr. Jakic.
Klaus-Rainer Jakic, ARD German Television. Mr. President, I also would like to touch on the decrease of the deposit facility rate. I do very well understand that the Governing Council is not too much interested in the profitability of the banking system. But on the other hand, aren't you concerned that there's maybe a lack of confidence in the population when it gets in the lack of confidence in the ECB of the population, if it gets the feeling that parts of the costing of the financial crisis are more and more shifted to them? And the second question, as you are aware, the CEO of the Deutsche Bank recently said on a conference that if the ECB is continuing this type of money policy, it may lead or will lead to a destabilization or a collapse of the financial system. What do you say to this comment? Thank you very much.
Thank you. Thank you. First, the first question. We certainly are aware of the side effects, the negative side effects on the people, especially in those parts of the Eurozone where the negative rates are being passed to corporate. So far as I understand, it's corporate depositors, and but it's an increasing percentage of them that is actually doing so. So we are concerned, and part of the reasoning about this is again, which has to do with the transmission of our monetary policy. Part of the reasons why we approved the tiering measures today, the mitigating measures, is also to try to soften, to reduce this transfer of costs to the borrowers. But we should be ultimately confident that with the recovery and the restarting of the anchoring of the inflation to our aim, the interest rates will go up at that point. People should explain that negative interest rates are a necessity, and that's very important. And I think the trust in the ECB ultimately will be based on whether it's delivered on its mandate of price stability or not. Has delivered on a variety of fronts, as I said before, more than 11 million jobs being created in a few years. And I'm pretty sure, and the German citizens certainly benefited from the ECB monetary policy for a long time and quite significantly. Now, the second point is about the comments made that negative rates are clearly, it's something, banks would like to have positive rates, unquestionably. So whenever they have negative rates, they don't like it. But I wouldn't go as far as saying that negative rates will cause the collapse of the financial system, because before getting there, one has to look at other things of our banks. For example, the cost-income ratio. Many of our banks have cost-income ratios which are completely way off any average indicator, both in Europe and even more so in the world, if compared with other banks in the other parts of the world. There are certain structural weaknesses in the banking sector, more pronounced in certain parts of the Eurozone than in others. I think these sort of considerations affect much more than negative rates, banks' profitability, banks' capacity to lend. The necessity to adjust the business model to the digitalization, to the changes